Hello everyone, my name is Nel El Dasal and I'm going to discuss the following. Dealing with investment bankers, risk in going public and borrowing from the banks. So, what is investment banking? It is a type of banking that organizes large, complex financial transactions such as mergers or initial public offer. Underwriting. These banks may raise money for companies in a variety of ways, including underwriting the issuance of new securities for a corporation, municipality, or other institution. They may manage a corporation's initial public offer. They will provide advice in mergers, acquisitions, and reorganizations. In essence, investment bankers are experts who have their fingers on the pulse of the current investment climate. They help their clients navigate the complex world of high finance. So basically, investment bankers are financial advisors to companies, agencies, and in some cases to government. You can just think of them as a middleman in a deal. They help their client raise money, arrange of a bond, negotiating the acquisition of a rival company, or arranging the sale of the company itself. Risk in going public. Rules and regulation by government. This means that the company is being supervised by government and have to follow the rules and regulation when operating a business. Loss of management control. This means that even if you are a major shareholder, you can no longer make independent decisions. The other minority shareholders have a say in how the company is managed. Enhanced reporting requirements. This means that the company have to make extensive quarterly and annual disclosure about business operations, financial conditions, compensations of directors and officers, and other internal matters. Increased liability is possible. Increase the potential liability of the company and its officer and directors for mismanagements, because if a company goes public, it has an obligation to its shareholder to maximize their profit and disclose operation information. Vulnerability. This means that other shareholder can attempt to change the company or even take over. Loss of privacy. If your company's privacy is known, it can cause disadvantage in managing the business and also can attract more competitors. Risk in borrowing from the banks. Personal liability. When taking out a business loan, the owners may have to use their credit to guarantee the loan. Small and new businesses would face this problem more often since they have not established a profitable history of or a record of paying money that has been borrowed. This means that the owner may have to use their own pocket and sign documents that state if the business doesn't repay the loan, the individual who owns the company will do so. Loss of assets. Sometimes a business loan will be guaranteed if the company has a proper collateral. Collateral is usually in the form of assets that are used to secure the loan. The loan company or banks would take ownership of the assets like equipment, land, and real estate if the loan isn't repaid according to the terms. Too much debt. Business can obtain multiple loans either at the same time or over time. If the loan are repaid and new ones is obtained, then the risk is minimized. However, if they obtain a loan and borrow more before the first loan is repaid, it may be a sign that the business is having a serious money problem that can lead to bankruptcy. interest rate fluctuation. Depending on the type of business loan, the company will have to pay back the principal of the loan as well as interest. This is typical, however, the interest repaid depends on the type of the loan. As interest rate increases, the cost of borrowing money becomes more expensive. This makes buying certain goods and services such as equipment, resources, and real estate will be more costly. And that's it for my report. Thank you.